Listen carefully, because moments like this don't announce themselves with sirens. They arrive quietly, wrapped in confusion, buried under headlines most people scroll past. China silver, 660 tons, a market that was locked and then suddenly reversed. That's not a coincidence. That's a signal, and history teaches us one brutal lesson. When the biggest players change direction without warning, it's never for small reasons. Today's not about silver alone. Today is about power, fear, leverage, and who really controls the global economic game. Right now, most people think markets move because of supply and demand. That's the stories they're told. But the truth, markets move because of intent. And when Beijing makes a move this big, it's not reacting, it's positioning. China's decision to release 660 tons of silver into the market must be understood as a deliberate supply-side maneuver rather than an act of financial stress. Nations with long-term commodity strategies do not liquidate strategic materials impulsively. They intervene when the balance between price stability, industrial demand, and geopolitical leverage begins to tilt in an unfavorable direction. This move reflects calculated intent, not panic. When a state with deep reserves and centralized planning opens the gates, it is because maintaining control has become more valuable than preserving scarcity in that specific moment. What makes this action especially revealing is timing. Silver had been tightly constrained, allowing prices and expectations to build on the assumption of limited availability. That assumption created fragility, speculative positions expanded, industrial buyers faced rising procurement risk, and price sensitivity increased across supply chains tied to energy, electronics, and defense manufacturing. In such conditions, scarcity stops being strategic and starts becoming dangerous. By releasing supply at scale, China disrupted that imbalance, forcing the market to reprice risk instead of chasing momentum. This is where many observers misread the signal. Dumping supply does not imply weakness when the seller controls the marginal flow. On the contrary, it reinforces authority. The ability to add the volume precisely when the market least expects it collapses speculative leverage and restores policy influence over price discovery. It sends a message that price formation will not be dictated by sentiment or financial positioning alone, but by physical availability controlled at the state level. That is power, not retreat. There is also a liquidity dimension that cannot be ignored. In an environment marked by tightening credit, elevated debt servicing costs, and slowing global growth, commodity markets increasingly act as pressure valves. Releasing silver injects relief into industrial pipelines without directly expanding monetary supply. It stabilizes input costs while avoiding the political and financial risks associated with overt stimulus. Few tools achieve both outcomes simultaneously, which is why this move matters far beyond the metals market. The most important hook is this. Strategic actors do not abandon assets they consider vital, they manage them dynamically. But China did not exit silver. It recalibrated the cycle. By sacrificing short-term scarcity, it preserved long-term control. Markets that rely on uninterrupted access were reminded who sets the terms, while those betting on perpetual tightness were forced to reassess their assumptions. When supply can be released on command, fear shifts sides, and in economics, the side that controls fear controls the market. Silver occupies a uniquely sensitive position in the global economy because it is not confined to a single function. It is simultaneously a critical industrial input and a financial refuge, and this dual role magnifies the impact of any policy-driven shift in its supply. When availability changes, the effects ripple across manufacturing floors and financial markets at the same time. Few assets carry this kind of structural influence, which is why movements in silver often reveal stress points in the system before they become visible elsewhere. On the industrial side, silver is deeply embedded in modern infrastructure. It is essential to electronics, renewable energy technologies, medical equipment, and defense systems. Demand in these sectors is not discretionary, it is strategic. When silver supply tightens, production costs rise. Project timelines stretch, and national priorities face friction. That creates a feedback loop where industrial demand becomes increasingly price inelastic, amplifying volatility the moment supply uncertainty appears. Buyers rush to secure material, and the market shifts from pricing value to pricing access. That is where instability begins. At the same time, silver carries a monetary identity that refuses to disappear. During periods of currency debasement, rising sovereign debt, or declining trust in financial institutions, silver transitions from an industrial commodity into a confidence hedge. Investors do not need a crisis to start buying silver. They only need to sense one approaching. This behavioral shift tightens available supply further, pulling material away from industrial channels and intensifying competition between financial and physical demand. The result is not just higher prices, but distorted allocation. Here is a critical hook. When an asset serves both factors in fear, it becomes systemically dangerous to mismanage. Any disruption in silver supply does not stay contained within one sector. It transmits stress across energy policy, technological expansion, national security planning, and capital markets simultaneously. That is why governments monitor silver more closely than many headline commodities. It is not the size of the market that matters, but its connectivity. China's ability to influence this balance gives it disproportionate leverage. Adjusting silver availability alters cost structures for industries while simultaneously reshaping investor psychology. That dual impact is rare and powerful. When silver moves, it does not whisper. It signals. It exposes vulnerabilities, compresses timelines, and forces decision makers to react sooner than they planned. In modern economics, assets that bridge the real economy and the monetary system do not just reflect conditions, they accelerate them. Control over supply elasticity is one of the most underappreciated instruments in modern economics. Yet it is among the most powerful. When a dominant actor can tighten or loosen availability at will, prices no longer respond purely to demand signals, they respond to policy intent. China's decision to first restrict and then reopen silver supply illustrates this principle with precision. The market was allowed to believe that supply was structurally constrained, encouraging leverage positions and forward assumptions built on permanent tightness. That belief, once widespread, becomes fragile. Price spikes, fueled by perceived scarcity, often attract speculative capital faster than they attract productive investment. As positions concentrate, volatility increases and the market becomes vulnerable to abrupt reversals. At that point, the risk is no longer price discovery, but price disorder, by altering effective supply elasticity. China disrupted this trajectory. A sudden increase in available metal expands short-term elasticity, forcing prices to respond to physical reality rather than financial expectation. This is where leverage collapses. Traders positioned for continuation are forced to exit, and momentum-driven narratives lose credibility. The hook lies in what this action prevents rather than what it creates. Uncontrolled price surges in silver do not benefit industrial economies. They raise input costs, destabilize procurement contracts, and introduce uncertainty into long-term planning for energy, electronics, and infrastructure. When volatility exceeds tolerable thresholds, it ceases to be a market feature and becomes a systemic risk. By reintroducing supply at scale, price movement is slowed, not stopped, and the curve flattens. Stability is restored without resorting to overt price controls. This method also preserves strategic ambiguity. Instead of committing to a fixed production increase or permanent release, flexible supply adjustments keep market participants uncertain about future availability. That uncertainty discourages extreme positioning. When traders cannot confidently model scarcity, speculative excess naturally contracts. Price behavior becomes more disciplined and volatility compresses. In economic terms, this is not suppression but guidance, achieved through quantity rather than rhetoric. Perhaps the most important signal is psychological. Markets are conditioned to assume that scarcity, once established, will persist. Breaking that assumption at a critical moment resets expectations. It reminds participants that supply is not passive and that policy actors remain present in the pricing mechanism. The power to redefine elasticity at key inflection points shifts the balance of control away from financial speculation and back toward physical governance. When that shift occurs, prices stop racing and start negotiating. The timing of China's silver release aligns closely with the global environment defined by tightening financial conditions, elevated debt levels, and declining tolerance for risk. As central banks maintain restrictive policies and credit becomes more expensive, liquidity does not disappear uniformly. It fractures. Certain sectors face acute stress while others remain insulated. Industrial supply chains, especially those dependent on critical inputs like silver, often absorb that stress first. Injecting physical metal into the market under these conditions functions as a targeted form of liquidity relief, one that bypasses financial intermediaries and moves directly into productive channels. Unlike monetary stimulus, which expands balance sheets and fuels asset inflation, commodity-based liquidity works quietly. When silver becomes more accessible, manufacturers face fewer bottlenecks, inventory pressures ease, and procurement timelines stabilize. Cash that would have been tied up in emergency stockpiling is released back into operations. That flow matters when margins are thin and financing costs are rising. The hook here is subtle but powerful. Not all liquidity is created by money printing. Some of it is created by removing friction where it hurts most. This approach also avoids political visibility. Large-scale fiscal or monetary interventions invite scrutiny, resistance, and unintended consequences. A strategic commodity release, by contrast, is framed as a market action rather than a policy rescue, yet its effects ripple outward. Downstream industries gain breathing room, contract renegotiations soften, price pass-through to consumers slows. In an era where overt stimulus carries credibility risks, indirect liquidity becomes an attractive alternative. There's also a defensive dimension. When global financial stress increases, commodities with monetary characteristics tend to attract speculative capital seeking safety. The capital can drain supply away from industrial users, exacerbating shortages precisely when the production stability is most needed. By increasing available silver, China reduced the incentive for hoarding and dampened the urgency that fuels panic buying. This stabilizes allocation without direct intervention in financial markets. The deeper signal is strategic patience. Liquidity injections through physical assets can be reversed without destabilizing currencies or signaling weakness. Silver can be released, absorbed, and later reaccumulated as conditions evolve. That flexibility is rare. It allows stress to be managed in layers rather than through a single dramatic action. When markets are stretched, the ability to relieve pressure surgically rather than systemically is a mark of control. In such moments, the quiet movements of metal can matter more than the loud decisions of central banks. In global commodity markets, actions speak louder than statements, and China's silver release functioned as a form of geopolitical communication rather than a routine trade decision. When a major state actor intervenes in a strategically sensitive market, other governments, institutions, and industrial players do not ask whether the move was profitable. They ask what message was being sent. This was not about maximizing revenue. It was about reinforcing presence, reminding the world that access to critical resources remains influenced by political capacity as much as market forces. Silver occupies a strategic category because it underpins sectors tied directly to national resilience, including energy transition technologies, advanced electronics, and defense manufacturing. By altering its availability, China demonstrated that it retains influence over inputs that matter far beyond pricing charts. The hook lies in recognition. Markets may trade silver daily, but nations plan around it. A controlled release signals that Beijing can affect cost structures and supply security across borders without issuing a single diplomatic statement. The signaling effect operates on multiple levels. To industrial economies reliant on stable silver supply, the message is conditional reassurance. Access can be improved when alignment exists and tightened when it does not. To speculative markets, the signal is caution. Price trajectories are not autonomous. They are exposed to policy intervention. This dual message discourages complacency and forces recalibration. It narrows the space for extreme positioning while widening the awareness that strategic commodities are never neutral. There is also an internal signaling component. Demonstrating the ability to manage strategic reserves reinforces domestic confidence in economic governance. It shows that volatility can be addressed through resource control rather than reactive financial measures. This matters in a world where economic credibility is increasingly measured by stability rather than growth alone. The capacity to influence outcomes without overt coercion enhances negotiating power across trade and diplomatic channels. Perhaps the most compelling hook is that this move shifts perception without confrontation. No sanctions were announced, no alliances were challenged, yet the reminder was unmistakable. In an interconnected global economy, influence is often exercised through subtle constraints rather than explicit demands. By adjusting silver flows, China illustrated how strategic leverage can be applied quietly, effectively, and reversibly. Those watching closely understand that when access to critical materials can be recalibrated at will, economic relationships operate within boundaries that are never written but always felt. Commodity cycles rarely end. They pause, reset, and resume under new conditions. China's silver release fits this pattern with precision, rather than signaling a structural exit from accumulation. The move suggests a deliberate recalibration designed to normalize inventories and expectations before pressure rebuilds. Strategic holders understand that extreme scarcity can be as destabilizing as oversupply. When prices detach from underlying industrial realities, the cycle becomes fragile. Resetting that imbalance early preserves long-term advantage. The key hook is counterintuitive. Those who expect shortages to worsen indefinitely often create the very distortions that force intervention. By allowing silver to flow back into the market, China softened the forward curve and reduced urgency-driven behavior. Industrial buyers were given time to adjust procurement strategies, while speculative capital was forced to reassess assumptions built on perpetual tightness. This cooling phase does not eliminate scarcity. It delays its consequences until conditions are more manageable. Historically, controlled releases of strategic materials tend to precede renewed consolidation. Once volatility compresses and positioning unwinds, accumulation becomes quieter and more effective. Prices stabilize at levels that discourage panic but still reflect underlying demand growth. In such environments, strategic buyers can rebuild inventories without drawing attention or accelerating price inflation. This is how cycles are extended, not broken. There is also a signaling effect embedded in timing. Resetting the cycle ahead of visible shortages allows policymakers to Claim stability rather than crisis management. When constraints re-emerge later, they appear organic rather than engineered. This preserves credibility while maintaining leverage. Markets that believe scarcity will return slowly behave very differently from markets convinced it is permanent. Expectations, once reshaped, become a tool. The deeper implication is that scarcity is most powerful when it is controlled, not absolute. By releasing silver now, China reduced immediate pressure while retaining the capacity to tighten supply later under more favorable conditions. That flexibility defines strategic dominance in commodity markets. Those who view this move as a surrender misunderstand the game. Cycle resets are not retreats. They are positioning maneuvers that ensure the next phase begins with order rather than chaos. When scarcity returns, as cycles suggest it will do so on terms set quietly in advance. So here's the final truth you need to hear. When a nation like China locks a market, then suddenly unlocks it, the question is never what happened. The question is what's coming. Silver didn't just move, a signal was sent. And signals like this separate those who react from those who prepare, those who chase headlines from those who read between the lines. The world is not running out of metal, it's running out of margin for error. Stay sharp, stay aware, because the next move won't come with a warning. And by the time everyone understands it, and the window will already be closed.